Hello everyone, Kenneth Amaduri here with CrushTheStreet.com. Today I want to talk about PE ratios. And basically it's going to be a beginner lesson, but I would imagine a lot of people out there will be intermediates and people who have some experience who want to understand PE ratios and what they're used for and have a better idea of what they're used for, because you're learning more about stocks, and it's usually not till you kind of get a little more into stock trading that you start to look up these sort of lessons. So let's get right into it. A PE ratio, what is a PE ratio? A PE ratio is fundamental analysis, and that's as opposed to technical analysis. And fundamental analysis deals with assets and liabilities and income and things that relate to the balance sheet and the fundamentals of a company, what a company is actually doing and what it's making and what it's spending and the cash it's bringing in, and evaluating these things in a numerical form that helps you understand the value of what you're purchasing. Now, technical analysis is a lot of charting and moving averages and looking at candlesticks and momentum and seeing what is going on with the movement of the stock and making decisions on whether or not a stock is going to move up or move back and trading it that way. So fundamental analysis deals more with the value of a company, and a PE ratio is absolutely fundamental analysis. Now, in general, PE ratios, and that, just to clear it up, PE ratio is price to earnings. That's what it means. The abbreviation or the acronym is price to earnings ratio. And it's always given in a per share basis. Now, if we were to actually look at the fundamentals of the entire company, you would look at the market cap divided by the earnings. The market cap is the value of the whole company divided by the net income of the whole company. But on a smaller level, on our level where we deal with per shares, everything is divided out. So if you take the top part, the numerator, which is the share price, it's the market cap divided by the total outstanding shares. If you're like me and like to have like a full understanding of what you're dealing with, this is what the per share basis is. It's market cap divided by the total outstanding shares, and that'll give you your share price. Now, the denominator is the net income of the entire company. And to get your per share basis, you divide it by the total outstanding shares, and you'll get your earnings per share. So a quick example of this is ABC Energy Company. This is just a company I made up just to give everyone a practical example. The price per share is $30, and it has an earnings of $2.50 per share. So the price divided by the earnings is a 12. So it has a PE ratio of 12. Now, I wanted to just explain why PE ratios are important. Many times people are looking at companies such as Apple, which trade for, right now it's like 550 or 500, and IBM, which is like 180, and Microsoft, which is around 37, and Google, which is around 1,000. And if you're a beginner and don't really understand the value of what you're buying, well, you would assume that Microsoft probably is the cheapest and Google is the most expensive. But that's not really, you can't analyze everything based on the price. You have to look at the price and divide it by the earnings. And that's a way to compare apples to apples when looking at companies. You can't compare IBM to Google because their earnings are different, their amount of shares outstanding are different, and the price is almost irrelevant if you don't understand the earnings and the outstanding shares. And the PE ratio is a way to compare apples to apples from one company to another. So here's a snapshot of a Yahoo platform of Microsoft. I like Yahoo. They got a nice little platform for me to basically analyze a lot of things. It's not perfect in every way, but for this purpose, it's got a nice little aesthetically pleasing display for us. So The market cap, the total value of Microsoft is here. $316 billion. That's what the total value. So if you divide that by the total number of shares outstanding, that'll give us our current price of $38.15. Now, right here, the EPS is $2.70 a share. So if you take the 38.15 and divide it by 270, we get our PE ratio of 14. And that is kind of our number to be able to compare Microsoft to IBM, to Apple, to Google, which all have PE ratios that vary, but it gives us a better way to compare this share price to another company's share price, and just looking at the PE ratio. So what does it tell you? It helps us to quantify the figure, helps us to quantify the share price. This next bullet point I have here, it helps us understand the value of what we are buying. So if we're purchasing Microsoft at a PE ratio of 14, it literally is telling us that we're purchasing this right now for $38. It'll take us 14 years to get our money back with the earnings. The earnings will take about 14 years to recover our initial investment in the company, and that's what a PE ratio theoretically tells you. Now we're not always going to receive that as a shareholder in the form of a dividend, but it quantifies that in terms of their earnings, how many years it'll take to recover that, and 14 was the number for Microsoft. So the next thing is comparing stocks and companies, apples to apples. Like I said, being able to compare IBM to Microsoft to Ford to any other company that's out there. Now, understanding the actual number of a PE ratio. Now, a low PE ratio could mean that a stock is undervalued. It could mean that the numerator, the share price, is really low and the earnings are really high, so it's giving us a relatively low PE ratio. And that could be that it was oversold, people reacted badly to news, and we're now showing a lower PE ratio, and it might be an indication that we should buy the stock. But it also could mean that the company is heading for a disaster. It could mean that people are selling the shares because they're anticipating bad news, or there is bad news, and that might not be a reason for you to buy it because there's a low PE ratio. It's just a way to value the company, and there's a lot of things you need to take into consideration. You can't just look at the PE ratio and make a decision on a company. You have to kind of look at the whole picture. But a PE ratio is a very good starting point for you to make a decision on your stock picks. Now, if it's in the mid-range, and I'm going to call low PE ratios maybe 10 and below, mid-range maybe 10 to 17, and it could just mean that the stock price is fairly valued. It's not set in stone. There's a lot of things you got to take into consideration, but maybe 10 to 15 or 17 could indicate a fair value PE ratio. And if you see something that's high, over 17 or maybe over 25, I mean, PE ratios, I've seen them as high as 100 or past that. And it could mean a few different things. It could mean that it's overvalued, meaning that the price is significantly higher than the earnings. The value of the stock is trading significantly higher than the earnings that it's producing, and it's causing a really high PE ratio. Or the price might be front-running the potential for earnings to really increase. So think about like a tech company coming out with some brand new technology that's going to shoot earnings significantly through the roof. So the price is going to run forward, and if earnings do in fact go up, well, that it'll kind of balance out that PE ratio eventually. So it's popular when new technology is coming out for PE ratios to be relatively high. Now again, that's the reason why you want to look at a lot of things at once to be able to decide on what the PE ratio is telling you and how to proceed forward. And I wanted to show this next slide because it's kind of like a good starting point for understanding if a company is undervalued or overvalued based on the PE ratio. And this right here is the SPDR S&P 500. So if you're looking at an American company and just across the general stock market, the American stock market, you look here, the PE ratio right now for the average company in the S&P 500 is 15. Now, if you remember, we were looking at Microsoft, and that was 14. So that means that Microsoft is actually trading a little below the average company in the S&P 500. And that might be an indication that you might be getting an undervalued company compared to the rest of the stock market. Now, it's not the end-all be-all for why you should purchase Microsoft or shouldn't purchase it, but it's a good starting point. Maybe after you look at that, you go and look at a technology index and see what the average price of technology companies and tech companies, computer companies are trading for, the PE ratio of those companies, and compare Microsoft to that. And then just make a decision. You have to look at what is Microsoft doing. Are they producing new technology? Are they investing in a lot of things? Do they have a lot of cash on their balance sheet? Are they treating their shareholders right? And just kind of make a decision from there. But that's kind of what a PE ratio is, and that's kind of how you can use it going forward in your decisions on whether or not you would like to purchase a specific stock. So for more information and videos like this, definitely check out crushthestreet.com and look for our following updates. Thanks so much.